Hello friends, welcome back to our third mock test of Indian Economy and Indian Financial System paper of JAIIB. Till now we have covered two modules of this paper and this video will cover the third module, that is Indian Financial Architecture. As usual, we will cover only important questions which have very high probability of coming in your examination. But before we start, don't forget to get your JAIIB Masters pack from the link given in description of this video. Now this is a pack of 4 Power Pack books. All these are 1000 series question bank of IEIFS paper, principles paper, accounting paper and then retail banking and wealth management paper. Now all these books contain super special 1000 plus questions which are very important for your examination. All the books contain real examination level questions and that too with updated difficulty level. Then these are chapter wise question banks, so it's easier for you to finish this in step by step manner. Not only this, these question banks comes with lots of case studies and numericals and that too with detailed solutions. The best part of this is that you get my full support with respect to any problem or any issue you may find in the question banks. All the links are there in description of this video, so don't miss out on these amazing books. So let's start with today's mock test. And the first question is from chapter Indian Banking Structure. And the question goes like this. A foreign bank intends to establish a presence in India but comes from a home country with insufficient regulatory oversight and disclosure norms. Considering RBI's guidelines on the entry modes of foreign banks, which operational model should this bank adopt and why? Now these options are given to you. That is, first option is branch model, then second model is subsidiary model, then third model is representative office model, and last option D is wholly owned subsidiary model, that is WOS model. Now friends, please note, according to RBI guidelines, foreign banks whose home countries lack adequate disclosure norms or regulatory supervision must enter through the wholly owned subsidiary model, that is WOS model. Now this model ensures better control and supervision by the RBI and also reducing risk associated with insufficient oversight from the bank's home country. Thus the correct option for the given question is option D. The next question is from chapter Microfinance Institutions and this is in fact a case scenario and it goes like this. A joint liability group, that is JLG, of 8 members, all small-scale farmers in a drought-prone district, is considering applying for a microfinance loan to invest in water-saving irrigation equipment. Given their shared economic background and collective liability under the JLG structure, the members are concerned about the potential impact on their individual financial situations if one or more members face crop failure due to unforeseen weather conditions. What mechanisms or strategies could the JLG employ to mitigate the risk of default while enhancing their collective creditworthiness, and what would be the implications of these strategies on the group's loan terms and repayment flexibility? And these options are given to you. That is, first option is the JLG should establish a group savings fund that can be used to cover shortfalls in loan repayments if any member faces financial distress, thereby reducing the likelihood of default and potentially improving the loan terms through demonstrated financial discipline and risk management. Then second option B is the JLG can seek a partial loan guarantee from an external agency or NGO which would absorb some of the default risk and allow the group to negotiate lower interest rates or more flexible repayment terms based on reduced risk to MFIs, that is microfinancial institutions. Then third option C is the group could negotiate with the MFI for collateral-backed loan where individual members pledge personal assets, thus ensuring full repayment but potentially putting members at personal financial risk which could undermine group cohesion. And last option D is the JLG might opt for a loan with a fixed repayment schedules that does not adjust for individual financial variability, emphasizing strict adherence to the repayment plan to maintain creditworthiness and avoiding any perception of financial instability. Now friends, the correct answer for the given question is option A. Friends, the strategy mentioned in option A leverages the collective nature of the JLG to pool resources for mutual benefit, thereby enhancing the group's resilience to individual financial shock and potentially allowing for more favorable loan terms due to reduced risk profile presented by the MFIs. So friends, I hope the explanation is clear to you. The next question is from the chapter Non-Banking Financial Companies, that is NBFCs, and it goes like this. An NBFC is evaluating its compliance with the criteria for being classified as a core investment company, that is CIC. The NBFC's total assets are valued at Rs 150 crores with 80% in form of investments in group companies, including equity shares constituting 50% of its total assets. Which of the following statements accurately describes the NBFC's compliance status with the RBI's definition of a CIC? And these options are given to you. That is, first option is the NBFC meets the asset size and investment requirements for classification as a CIC. Then second option B is the NBFC meets the investment requirement but fails to meet the asset size requirement for classification as a CIC. Then third option C is the NBFC meets the asset size requirement but fails to meet the investment requirements for classification as a CIC. And last option D is the NBFC fails to meet both the asset size and investment requirements for classification as a CIC. Now friends, please note a core investment company, that is CIC, must have an asset size of Rs 100 crore or above and hold not less than 90% of its total assets in form of investments in equity shares, preference shares, debts or loans in group companies. Additionally, the investments in equity shares in group companies must constitute not less than 60% of its total assets. So please note these important facts. But in our case given in the question, the NBFC meets the asset size requirement of Rs 100 crores but fails to meet the investment requirements, as only 80% of its assets are in group companies' investments as compared to the required 90%. And also equity shares constitute only 50% as compared to the required 60%. So I hope by now you can easily answer the question. So as far as this question goes, the correct option is option C. Now, before moving ahead, don't forget to subscribe this channel, since this is the only channel that provides quality content. Also join my Facebook group where I post lots of one-pagers, mock questions and other useful stuff which is very important for your examination. You can also join my Telegram channel and connect me on my LinkedIn profile as well. All the links are there in description of this video, so do join after you finish this video. The next question is also from the chapter NBFCs. And the question is, an infrastructure finance company, that is IEFC, is planning to diversify its loan portfolio. It currently has a total assets of Rs 500 crores with 80% deployed in infrastructure loan. The company has a net owned fund of Rs 350 crores, a credit rating of AA and a capital to risk weighted asset ratio, that is CRAR ratio, of 16%. Which of the following changes would cause the IFC to lose its classification as an infrastructure finance company? And these options are given to you. That is, first option is reducing the proportion of infrastructure loan to 70% of total assets. Then second option B is reducing the net owned funds to Rs 280 crores. Then third option C is reducing the CRAR to 14%. And last option D is receiving a credit rating down to A-. Now friends, please note an infrastructure company, that is IFC, must deploy at least 75% of its total assets in infrastructure loans, having a minimum net owned fund of Rs 300 crores, also a minimum credit rating of A or equivalent, and a capital to risk weighted asset ratio, that is CRAR, of 15%. So please remember these very important facts. So in our question, by reducing the CRAR to 14% would cause the IFC to lose its classification because it falls below the minimum required CRAR of 15%. But other changes do not breach the required thresholds for classification as an IFC. So as far as this question goes, the correct option is option C. The next question is from chapter Insurance Companies, and the question is, consider a scenario where the insurance penetration in India is observed to be below the global average, and Insurance Regulatory and Development Authority of India, that is IRDAI, is keen on improving its metric to match the international standards. Data from the latest fiscal years indicates the total insurance premium collected was Rs 7 lakh crores. The GDP of India was Rs 300 lakhs crores and population was 1.5 billion. The IRDAI has set a target to increase insurance penetration by 1% within the next 5 years. To achieve this target, IRDAI has planned several strategic interventions, including mandatory insurance awareness campaigns, incentivizing digital insurance platforms, and introducing micro-insurance products. What will be the required premium collection at the end of 5 years to meet the target penetration, assuming a constant GDP growth ratio of 7% per annum? And these options are given to you. That is, first option is required premium collection of rupees 9.05 lakh crores. Then second option is this, third is this, and lastly fourth option is this. Now friends, please reread this question by pausing the video if you still can't understand what's asked in this question. Now please note, insurance penetration is calculated as a percentage of total premium collected to GDP. So the current penetration is simply 7 lakh crores divided by 3 lakh crores multiplied by 100 equals 2.33%. Now IRDAI wants to increase this penetration by 1%, that is after 5 years, they want this penetration as 3.33%. I hope this is clear to you. Now question wants us to find the premium collection. And for this we need to find the GDP after 5 years, so that we can plug in this GDP in the formula and get the required premium collection after 5 years. Now friends, with the 7% annual GDP growth rate, the GDP at the end of 5 years will be simply 300 multiplied by 1 plus 7% raised to the power 5, which on solving gives 421 lakh crores. Now friends, we got our insurance penetration rate after 5 years and also GDP after 5 years. So just plug in these values in the formula. We get required premium collection as 3.33% multiplied by 421 lakh crore rupees equals 14.02 lakh crores. Thus the correct option for the given question is option C. Then next friend, if you are enjoying the content and found it useful till now, then don't miss to like this video, since this tells me that you are loving the content and it also motivates me to make more such awesome videos. So hit like and also subscribe this channel. Next, let's move forward with our mock test. The next question is from the chapter Indian Financial System Regulators. And the question goes like this. The Monetary Policy Committee, that is MPC of India, plays a critical role in setting the policy interest rate to achieve the inflation target. Assume the MPC has set an inflation target of 4% with a tolerance band of plus minus 2%. However, due to external shocks like rising global crude prices and depreciating currency, the current inflation rate has surged to 6.5%, while the GDP growth rate has slowed to 3%. Given these economic conditions, evaluate the possible action the MPC might consider and their likely outcome on the broader economy, focusing on the potential trade-offs between controlling inflation and supporting economic growth. And these options are given to you. That is, first option is the MPC might choose to increase the repo rate, which would help control inflation but could further dampen economic growth due to higher borrowing costs and reduced consumer spending. Then second option B is the MPC is likely to decrease the repo rate to stimulate growth, as the primary focus should shift towards economic recovery, even if it means inflation might exceed the upper tolerance band. Then third option C is the MPC will maintain the current repo rate, prioritizing stability over immediate intervention, allowing market forces to address the inflation and growth disparity naturally. And last option D is the MPC could implement targeted credit easing measures to specific productive sectors to stimulate additional growth concerns while keeping the repo rate unchanged to maintain inflation control. Now friends, the correct option for the given question is option A. Now in the question, we are given the scenario where inflation has surged to 6.5% due to external factors like rising global crude prices and a depreciating currency. And the Monetary Policy Committee, that is MPC, is faced with the challenging trade-off between controlling inflation and supporting economic growth. Now, as given in the question, the MPC's primary mandate is to maintain price stability within the targeted range of 4% with a tolerance band of plus minus 2%. So with inflation exceeding the upper limit of this range, the MPC is most likely to prioritize controlling inflation over stimulating economic growth. So by increasing the repo rate, the MPC aims to reduce the money supply in the economy, thus making borrowing cost expensive. Now friends, please note this action in fact helps to curb the demand side inflationary pressure, and which can ultimately help in bringing back inflation back to within targeted range. But friends, the trade-off is that higher interest rates could further slow down the already weakened GDP growth of 3%. as businesses may reduce investment and consumer might cut back on spending due to higher borrowing cost. So as you can see, this decision could negatively impact short-term growth. But MPC's stance is based on the understanding that unchecked inflation can erode purchasing power, destabilize financial markets, and hurt long-term economic prospects. Thus, the MPC's decision to raise the repo rate reflects a prioritization of macroeconomic stability through inflation control, even at the cost of temporary economic slowdown. So friends, I hope the explanation is clear to you. The next question is also from chapter Indian Financial System Regulators. And the question goes like this. A commercial bank in India is facing a sudden liquidity crunch and needs to borrow funds overnight. The bank decides to access the marginal standing facility, that is MSF. What would be the implication for the bank under the MSF arrangement? And these options are given to you. That is, option A is the bank can borrow up to 5% of its net demand and time liabilities, that is NDTL, at the rate 50 basis points above the repo rate. Then second option B is the bank can borrow up to 2% of its NDTL at a rate 100 basis points above the repo rate by pledging government securities. Then third option C is the bank can borrow an unlimited amount of funds at the prevailing repo rate. And last option D is bank must sell government securities outright to the RBI at the repo rate under open market operations, that is OMO. Now friends, as you all know, the marginal standing facility, that is MSF, is a monetary policy tool introduced by the Reserve Bank of India in 2011 to help commercial banks manage their short-term liquidity needs, especially during unexpected liquidity crunches. So under MSF arrangement, bank can borrow overnight funds from the RBI by pledging government securities. This facility is particularly designed as a last resort when banks face acute liquidity shortages that cannot be met through other means, such as interbank borrowings or the liquidity adjustment facility, that is LAF. Now also remember, banks can borrow up to 2% of their net demand and time liabilities, that is NDTL, under MSF at a rate that is 100 basis points, that is 1% above the prevailing repo rate. Now this higher interest rate acts as a hurdle for banks. That is, it encourages banks to rely more on regular market mechanism for liquidity management and using MSF route only during genuine liquidity stress situations. So friends, MSF provides a safety net for banks, ensuring that they can maintain their statutory liquidity ratio, that is LSR, even when liquidity is tight. Not only this, MSF facility also helps stabilize the financial system by preventing abrupt disruptions in the interbank market due to liquidity shortages. But please note, frequent reliance on MSF signals underlying financial stress in the banking system, which is why it is intended for emergency use rather than routine liquidity management. So friends, I hope with this explanation you can easily identify the correct option, that is option B. The next question is from the chapter Reforms and Development in Banking Sector, and the question goes like this. Bad bank is established with the aim of taking over non-performing assets, that is NPAs, from other banks to streamline the process of asset recovery. In its operational structure, the bad bank consists of two entities, the National Asset Reconstruction Company, that is NARCL, and Indian Debt Resolution Company, that is IDRCL. What is the primary role of IDRCL in this setup? And these options are given to you. That is, first option is acquiring NPAs from commercial banks. Then second option B is managing and resolving the assets acquired by NARCL. Then third option C is providing high interest loans to business for recovery. And last option D is offering financial advisory services to NARCL. Now friends, this is an important question, so please note, in a bad bank, IDRCL's primary role is to maintain and resolve the assets acquired by NARCL, while NARCL focuses on acquiring and aggregating stressed assets. So IDRCL operates as a service company that engages market professionals and turnaround experts to manage, restructure and add value to these assets, and thus ultimately aiding in their recovery and resolution. So the correct option for the given question is option B. The next question is from chapter Banking Laws, RBI Act 1934 and Banking Resolution Act 1949. And the question goes like this. A banking company, New Silchar Bank Limited, acquired an immovable property in 2015 due to the default of a borrower. By 2023, the bank still holds this property, which it does not use for its own operations. Considering the Banking Regulation Act 1949 and the specific provisions for holding immovable property, which of the following actions should New Silchar Bank Limited undertake to remain compliant with the Act, assuming the Reserve Bank of India has not granted any extensions? And these options are given to you. That is, first option is New Silchar Bank Limited should immediately dispose of the property regardless of the market conditions as the 7-year period has elapsed. Then second option B is the bank can retain the property indefinitely as long as it does not engage in trading activities involving the property. Then third option C is New Silchar Bank Limited may apply to the RBI for the extension to retain the property for up to an additional 5 years, provided it demonstrates that disposal within the original period would harm the depositor's interest. And last option D is the bank should transfer ownership of the property to a subsidiary company within the group to avoid direct contravention of the Act. Now friends, the correct option for the given question is option C. So according to Section 9 of Banking Regulation Act 1949, a banking company is required to dispose of any immovable property acquired other than for its own use within 7 years from the date of acquisition or commencement of the Act, whichever is later. However, the Reserve Bank of India may extend this period by up to 5 years if it is in the interest of depositors. So, I hope the explanation is clear to you. So friends, finally we have reached the last question of our mock test, and the question is from chapter Banking Laws, RBI Act and Banking Regulation Act 1949. And the question goes like this. The Reserve Bank of India is authorized to engage in transactions related to rediscounting bills of exchange under specific conditions to support the financial system. If the RBI decide to rediscount a bill of exchange related to export activities, which of the following conditions must all be met for the transaction to be legally compliant according to RBI Act? Now the first statement is the bill must be drawn and payable in India involving a transaction directly linked to the export of goods from India. Then second statement is it must bear at least 2 signatures, including one from a scheduled bank or a state cooperative bank. Then third statement is the bill should mature within 180 days from the date of purchase or rediscount, excluding days of grace, to ensure short-term liquidity management. Then fourth statement is the counterparty to the transaction must be a financial institution predominantly engaged in the acceptance or discounting of bill of exchange and promissory notes. Now, which of the following combinations correctly identifies all the necessary conditions? And these answer choices are given to you. Now friends, the correct option for the given question is option D, that is, all the listed conditions are required for RBI to rediscount bill of exchange related to export activities. Now, this involves ensuring the bills are drawn and payable within India, bears at least 2 good signatures, including that of a scheduled bank or a state cooperative bank, then mature within 180 days to support liquidity needs, and lastly handled by an institution predominantly involved in managing such financial instruments. Now, this approach ensures that RBI supports only genuine export activities while also maintaining sound financial practices. So friends, with this I wind up this video. I hope you found the content really beneficial. Also, don't miss to get your JAIIB Masters Pack from the links given in description of this video. The combo pack comes at a discount as well, and you can even get individual books and also their online versions. So thank you, and I will meet you again in another video.